In this presentation, we will enter adjusting entries related to insurance. For more accounting information and accounting courses, visit our website at accountinginstruction.info. Before we get into the adjusting entry process here, note where we are at. We're currently in the adjusting entries tab as opposed to the journal entries tab where we had been entering the journal entries for the entire month. This being where we normally do most of the work, where we do most of the transactions. We're going to move to an adjusting entries tab, and this is typically done when doing adjusting entries. We're going to kind of separate this out. We're going to pull this out of the normal process so that we can analyze it better. We can analyze it separately. Why is it better to analyze this way? Because what we're going to start with is an unadjusted trial balance, give a quick representation of those adjustments, and then have an adjusted trial balance. It really gives our information really fast and gives us a quick idea of what happens. I'll give a little bit more detail as to why that is, but first let's take a look at what does it mean to be an unadjusted trial balance and an adjusted trial balance. The unadjusted trial balance is just being pulled from our journal entries here. So I'm going to go back to journal entries. And this trial balance, all we're doing, see it's called trial balance here because they're all just trial balances. So really when we call it unadjusted, it's just really talking about at what point in time are we using this trial balance. They're all just a trial balance really. But so here we have a trial balance that has had the data input throughout the month. We're just going to take these same numbers and go over here to the adjusting entries tab. Same numbers here. Now we're just going to call it an unadjusted trial balance because for our worksheet, we haven't adjusted it, meaning we haven't done the end of the period adjusting entries, which we will do now. And we're going to post that not to the GL, but to this little center column, and then get the adjusted trial balance, which will just kind of be those two columns. It will be those two columns summed up. And why would we do that? Why is that better? Because note that if we had a lot of transactions to accounts receivable, posted them all to this middle column, wouldn't give us much detail. The GL is needed then, because we need to see all the detail. But if we only have one thing posted here, or two, or even three, then this one column is much faster for us to see, okay, this is where we started, this is what we did, this is where we end. So for a few transactions, this is much better. For an entire month of transactions that has a lot of information in any particular account, we need a GL in order to see all the activity. If there's only one thing happening, then we only need one column to see the activity, and we can see a really quick format here. Also note that because we put the debits in there as positive and the credits as negative, this is a very simplified worksheet. The formulas are very simplified for Excel as compared to many worksheets that you'll see. And the only reason for that is just because of the way we're using debits and credits here. So in other words, if we had two columns for debits and credits each time, we would have two columns here, we'd need two columns here, we'd need two columns here, we'd have 6 columns in our worksheet, and the formulas would be more complex because we'd have to use plus and minuses with 6 columns. Here we only need 3 columns, and the formula is just a sum function, or adding should be a sum function, same thing. So that's what we're going to do here. Now the adjusting entries, when we think about them, note that there's going to be a few rules that if we know them, then we can make this process easier. So the rules are going to be cash is never affected because it's an adjusting entry and they deal with timing differences. Now note that if there's an error or something like that, we might do it at the same time that we do adjusting entries. Meaning we might do non-adjusting entries that are fixing errors at the same point in time we do the adjusting entry process. But they're really separate. Adjusting entries are not errors. They're part of the normal accounting process. So you want to keep the two separate in your mind. If something is truly an adjusting entry, they're part of the process. They're not a problem that happened in the data entry process that we now need to fix. They're things we planned for and are now implementing that plan. So there's typically going to be one balance sheet account, at least one, and typically a balance sheet meaning asset or liability, not an equity account, and then one income statement account, revenue or expenses, and the income statement accounts we know only go up. They only go in one direction, and therefore we can decide, we know which way the income statement account is going without even knowing what we're doing. So let's apply those rules as we go through, and this will help us to kind of do the adjusting entries without really understanding what we're doing. And then we'll talk about understanding what we're doing, why we're doing it. Let's apply this to insurance. The first one, we're going to do an adjusting entry related to insurance. So our data here says insurance expired during a month. So it's going to give us the insurance that was expired during the month. So without even knowing what that means, we can go back over here and say, okay, well, cash isn't involved. I can eliminate that. And then we know that there's going to be something in the assets and liabilities, the balance sheet accounts above equity related to insurance. And if we just look through prepaid insurance, okay, that looks like a contender. I'm going to make a little yellow dot or square, rectangle, I suppose, here, just to indicate that that's one we're going to use. And then down here on the income statement, there's going to be something related to the income statement according to our rules related to insurance. And how about, I don't know, insurance expense? That looks like the one, so we're going to put a yellow dot there. So note how it's pretty black and white in terms of pretty clear what our accounts are going to be usually with these adjusting entries. You know, the name will be in there, insurance, supplies, wages, or something like that. And we also know that the insurance expense is an expense. All expenses have debit balances. They only go up in the debit direction. So we know we're going to debit it. So we know that even. So I'm going to right click and copy insurance. I'm going to say if this is an account we're going to be using, it must be the one that we're going to debit. So we'll put that in C5, right click and paste 1, 2, 3. This is as of the end of the month, as all adjusting entries are, because we're fixing this as of the balance sheet date, 1/30. And then if we're going to debit the insurance, we must be crediting the other account. If this is the other account we're using, we must be crediting it. So I'm going to copy that, say that must be the credit, right click and paste 1, 2, 3. I'm going to format this, home tab, alignment, increase, indenting, and that's going to be what we have there. Now, we can get all that without even knowing really what we're doing. We just know that we're doing an adjusting entry related to insurance. Now let's talk about what we're doing and, you know, to get the number portion. So remember when we paid for insurance, and what we have to do on these is really kind of know how these accounts got there and then how to fix them. When we paid for insurance, we paid cash, credited cash. We debited not insurance expense, obviously, because it's zero, but prepaid insurance. Why? Because insurance is paid before we get the coverage. So this is 12 months worth of insurance here. And if we were to have expensed 12 months worth of insurance in January, it would bring down January's net income a lot. And when we compare January to February, it's unfair to January. We'd have net income too low for January compared to February because we allocated a whole year's worth of insurance to it. How do we make it fair to January to really be able to see our performance and judge our performance in January as compared to February? We allocate the proper amount that was actually consumed, which is going to be 1 month. Now here, note that we bought this like in the middle of the month or something, but we're going to assume that it was a whole month of January that we have insurance for. So we bought 12 months, we consumed 1 month. So the calculation would be something like this. We're going to say equals 12 months worth, 12,000, divided by 12. So 12 months. So that means that we have consumed then at the end of January, if we purchased it at the beginning and January was covered in the policy and we paid for a year's worth, then 1 month had passed and we have 1,000 worth of coverage that we have now consumed and therefore should be expensing. And I'm going to say negative of this number. So that's what we have here. So if we post this to our middle column, we'll see if it does what we think it should do. What do we think it should do? Insurance expense should go down to 11 months worth of insurance expense, which has not expired yet, this being still an asset, which would be 11,000. And the expense should go up by 1,000, the amount that has expired, bringing net income down. Let's see if that is indeed the case. Here's the insurance expense. We're going to go down here, insurance expense. We're going to be in the middle column in I-26, where we will say equals. Scroll back up, pick up that 1,000. And I'm going to scroll down just for some suspense here before I hit enter. And we're going to say that this is going to go up by 1,000. This is going to be out of balance by 1,000. Net income is going to go down. So enter. This goes up by 1,000, out of balance, net income went down. We were at 19.6 net income, revenue minus expenses, not loss. it's going down by the expense to $18,600. Now we'll record the other side, insurance, prepaid. Here's prepaid. Here's prepaid. We're going to be in the middle column in I-9 equals this 1,000. 12,000 goes down by that 1,000 to 11,000. So there we have it. We're going to be back in balance. Note, once again, balance sheet account affected, prepaid insurance going down, and income statement account affected, expenses going up, bringing net income down. 1 month of insurance now expired and put here. 11 months still left, which have not yet expired and therefore are still assets. For more accounting information and accounting courses, visit our website at accountinginstruction.info.